And thank you so much for sparing of your time and that too on a weekend and Sunday. But I think we are all aware and a lot of things happening ever since the report of the internal working group set up by RBI. Good morning, Vishwanathan sir. So there was like the report which came up, the draft report, the report, and based on which RBI has also sought reactions and feedback from public and common people. And there's been a lot which is being talked about. There is a lot which is being written in the media. So we thought that we should have a structured discussion and maybe prepare some kind of a report and maybe send that to RBI based on. So today we are very, very fortunate. Good morning, Vishwanathan sir.
Good morning. I'm audible.
So we are very, very fortunate to have you all. And I think the real, I would say the true think tank in the financial services space, all of you individually are what should I say, icons by yourself. So fortunate to have, the regulator side. We have Sinha sir, who's been Minister of State for Finance, and we know how actively and how much he understands the finance. And of course, some of the the practitioners. We have TTS sir, Sundaram Finance MD. We have Kishore, who's the CFO of Hinduja Leyland Finance, and Kapish Jain, he's the CFO of PNB Housing Finance, and of course, Dr. Jeet Pai, the think tank of the government, and our own Dr. Charan Singh, of course, not only a banker, but a well-known economist who's served with the IMF also. So great to have all of you. So just to quickly kickstart. So as we said, I mean, the idea is that while we can take the report of the internal working group and its recommendation as the base document, but that does not limit us, because I know, I mean, as I said, each one of you are far more experienced and knowledgeable. We would love to hear also anything which has not been said in the report and you think is very, very important and is important in this context, because we are talking of future private banks, the banking licenses, the guidelines, and what should be done and what not to be done. So I would request not only to limit to this report, but anything outside and anything beyond. One more, I think this point which I would, from my side, I thought we'd also relevant is that the recent development where we saw this merger of Lakshmi Vilas Bank with the DBS Bank, which by itself is a very, very unique thing to happen, and it never happened. It has happened in the past that a bank, Indian bank, has been merged into a foreign bank, and one, so to say, controversy which is going around, and we all know, which has been also dragged to the courts, is about the shareholders' stake. And we are witnessing people obviously going around that why should shareholders suffer, and practically the shareholding comes to a big zero today. So how far is that correct, and do you think something could be done on that front? I think that is another critical point, because this issue did come up in the case of Yes Bank also. So I think this is another point from my side I thought I will add, which is a subsequent development to this report. So with this, I'll quickly hand over to Mr. Avtar Monga, who chairs the banking chair at CIU. If there is quick remarks, and then we can seek all of yours individual comments and thoughts. So Avtarji, please.
Thank you, sir. Thank you very much. And Vishwanathan, sir, first of all, good to see you. You looking much slimmer. Looks like you're in Bangalore.
Yes, I'm in Bangalore.
Yeah, I can see. So I hope everything is okay. So morning, everyone. Basically, the question really is, what are we trying to achieve by doing this new format, whereby corporates with a certain amount of vintage, experience, and size, those are the kind of parameters which have been broadly laid out, have the ability. It's not an entitlement. There's still a process which will be gone through, and there'll be a very deep level of scrutiny, I'm sure, which will allow them. So the fundamental question is, what are we trying to solve for? So I thought my discussion, I should, kind of give you a perspective, which is that if you look at the last 20, 30 years of how I would say right from the time 94, when the private banks actually came into existence in a real way, and what has been changing, some of them have actually grown to become fairly formidable competition to the PSU banks, and PSU banks also have evolved in a big way from being not so tech driven to a very tech driven, especially State Bank of India and many of the other banks like Bank of Baroda and all that. But one fundamental thing which has not been actually discussed, which is what we're going to do today, is what is the better model? Is the promoter led model a better model or a professional model? Because both have their own pluses and minuses, and this proposal actually takes a form where the promoter led companies will be back into the business of doing banking, which is a public service in a way, because it's not just lending, it's more to do with depositors interest and other things. So one way to think, actually two ways to think. One is to think about, if you look around and ask how many companies in the banking space have failed in the last 20 years, and what were the basic reasons and thoughts as to why that happened. I would argue that most of the PSU banks have, wherever there was a trouble, it was largely actually driven by the promoter lending sort of a structure. And also was driven by sometimes the favors and all that. That's my perspective. I might be wrong. And the second observation I would say is that many of the private banks which actually have had trouble like that were largely driven by the promoter having a significant involvement and not letting the professionals, really run the company. And I don't want to get into the details of LVB because its matter is sub judice. But what I read from the newspaper and little bit I know otherwise is that there is also a portion of that kind of playing somewhere. So to me, the other angle is that yes, we've had a couple of new changes in the recent times, both on the commercial bank front and also on the small bank front. I think somebody is not on mute, please. Can you please? And if you look around, let's take payment banks. How many licenses were actually given? How many are standalone success stories? Yes, there is a Paytm payment bank which is profitable, and the others are still not there. The other example is these MFIs, which were doing a terrific job, and they're doing. Martin sir, good morning. Uh, they are all very well serving the last mile of this country, which is very critical, and the expansion of the network really has helped a lot of people who are new to credit, and then many of these successful MFIs finally became what is now called a small finance bank. But even there, how many of them actually have moved from actually truly being a deposit base? Very few, and some of them who have made it have actually not gone beyond a certain number. So these are the broad questions saying, what are we trying to solve for? And I would also say, and this is my personal view, that my summary assessment is wherever the professionals were brought in to do a structural, big change like this, and then they stayed for too long, ILFS being a case in point here. And I don't want to take more names, but I could take a few more names if you like. There, beyond a certain time frame, because there's no rotation of the management, which is one of the biggest norms, a positive norm in the PSU structure. No matter who you are, you will be replaced by somebody. And that kind of has its own inbuilt benefits, because it kind of changes the control. It always keeps you on your toes, and you're always looking at how long I'm there. And so those are the things. So I thought I'll at least table this, and then we have a conversation around all of these parameters. So I think this is a very important topic. Of course, we're going to discuss and take all inputs. I'm not suggesting whether this is absolutely a wrong thing to do or a right thing to do, but these are the few parameters where people probably will have some views around what's the right structure and what is the real. And frankly, this is happening at a time when the cleanup has been taking place for quite a while, and it's almost getting to the end of the phase where probably in the next 12 to 18 months, all the leftover, big ticket, NPA discussion should be over. So that's where I am. So I thought I'll at least give the opening remark, which is my personal view. So back to you, Mr. Agarwal,
Thank
or
you.
Nilesh.
Thank you. So we have Anilesh Mahajanji, who's the backbone behind CIU. So good morning, and Anilesh ji. So
Good morning, everybody. I'm sorry, because of the GRAP rules, the backup of my society was not there. So the electricity failure means actual going back into the last decade.
Anyway,
There was complete darkness and the electricity
so
just
I think
back.
good that at least you made it. So good.
Thank
So I think now we can start the discussion. So I think the key points which are emerging, really points of discussion. Of course, one relates to the initial promoter stake and the lock-in period, and the idea of how much ultimately should the stake be, as the group has recommended raising that level from 15 to 26%. That's I think one major point which is being discussed. Then of course is the eligibility of promoters, where the group has for the first time recommended considering corporate and industrial houses for to be given banking licenses. Of course, after taking care of concerns about connected lending and the associated amendments to the Banking Regulation Act. And and added to it is another very important aspect of the conversion of NBFCs into banks, and where the group is recommending 50,000 crores and above asset base, and should be considered for a banking license. And of course the continuation of the non-operating holding company structure. So I think these are the broad points. So throwing the discussion open, let me first invite Jain Sinha sir, uh, because you've had really the grasp of the thing, because being at the North Block, and then ever since being actively involved in the financial matters, and with your knowledge, your thoughts, sir.
Thank you very much, Ramanji, and good morning to all the distinguished participants in this seminar. Let me first request everybody to put their microphones on mute. I think there is some background noise. So if everybody can just put it on mute, then we can eliminate all that background noise. Let me also reiterate that I'm speaking in my personal capacity here. I am not speaking either for the government or alternatively as a member and chair of the Standing Committee on Finance, which of course I chair in Parliament. And of course, as a result of that, we have oversight of all the banks and Reserve Bank of India and so on. So we have very serious and important discussions there. And of course, we issue reports that are the considered view of the committee. But here, I'm only going to present my own personal views, neither the views of the government, as I have gleaned it from discussions with the finance minister and others, even the discussions we had in our committee. These are just my own personal views. And I want to start by going back to the question that Avtarji posed, which is, what is the problem we're trying to solve? If we want promoters, or if you want corporate houses to be involved in banks, why do we want that? What is the problem we're trying to solve? And as we know right now, we've had in the banking system in India at least three very important interconnected problems. Number one, we've seen that credit growth, particularly on the public sector side, has not been fast enough, and it hasn't been to the sectors that we would like. First, there was too much project lending. Now there's no project lending, and so on. So the lending has not been as fast as we would have liked it, and into the sectors that we would want. I'm not sure whether there are many other, countries, major economies, where you have even the concept of priority lending. You intervene and have priority sector lending tells you that lending is not happening at the pace that we would like in the sectors that we want. So the first problem we are dealing with is lending. The second problem that we are dealing with is the underwriting function as such, which is where the whole NPA problem arises. So we've got a big NPA problem, and obviously linked to the NPA problem, which is the Insolvency and Bankruptcy Code hasn't done a good enough job of dealing with that yet. We have a third problem, which is a problem of capital, again, particularly for the public sector banks. So three interconnected problems: lending not happening at the pace that we would like into the sectors that we want. Number two, even if it happens, the level of NPAs are absolutely unacceptable. And then number three, related to that, is we don't have enough capital for growth. And all three are interconnected, and all three are creating real challenges for the financial system. Now, most of these problems actually are concentrated with the public sector banks. If you look at the banks, particularly the larger ones like HDFC Bank and Kotak and IndusInd Bank and so on, they have actually been doing quite well. Obviously, we all know the facts, which is that today HDFC Bank has a market capitalization of greater than 8 trillion rupees, 8 lakh crores. Kotak Bank is coming up fast. And together, HDFC and Kotak Bank individually have more, higher market capitalization than all the public sector banks combined. So they don't lack for capital. Their multiples are extremely high. They are able to attract capital from shareholders and from the broader sort of bond markets as well through tier 2, tier 3 type credit borrowing. And as a result of that, they have been growing and expanding. And in fact, the latest RBI numbers are very sobering for the public sector banks and should concern all of us as citizens, which is that if you look at either lending or you look at 70% public sector banks market share there to now to about 56%. So the market share of public sector banks, because they're not lending and because depositors are becoming more concerned about them, has been starting to dip very sharply in the last 5 years. This is a tectonic shift to get down to 56%. So because of the problems that I was referring to earlier, all the value has gone into the private sector banks, and now increasingly both the deposits as well as the asset book is now shifting towards the private sector banks. Now this should concern us greatly as citizens, because as we've already seen, and I have personally dealt with Air India or BSNL and MTNL or BHEL or many other public sector entities, all the value is being shifted from the people of India to a few people, right? So the private sector banks are owned by corporates. There's a lot of value creation, 8 trillion rupees for HDFC Bank alone. And all that value has from public sector banks to the private sector banks. And this is what it is demonstrating is a lack of confidence in the future from equity investors. And of course, a situation where people are increasingly beginning to think that the public sector banks are going to remain frozen, they're not going to grow, etc. So in a nutshell, this is the set of issues that we're dealing with. This is the problem we are dealing with. Not enough capital, too high NPAs, not enough expertise, and at the same time, value being taken from the public sector side and going over to the private sector side, and which has its own concentration of wealth, inequality, and other aspects associated with it. So from a policy perspective and a national perspective, these are very serious, sobering issues that we have to contend with. Now, given that backdrop and given the recommendations, should we try and solve the problems that I just outlined by bringing in, corporate and industrial problems? I'm not sure. I think the real problems that we have to work towards is to make our public sector banks much, much more competitive and be able to attract capital at much better rates than they're able to do right now. That really is the number one priority. And on the private sector side, I don't see a situation right now in the private sector where there is any challenge in attracting capital. Avtarji just spoke about the fact that we've been able to merge Lakshmi Vilas Bank with DBS. And it just happened that quickly because DBS really, really wanted to come into India. And today, if you look at foreign banks or you look at investors, foreign investors and so on, more than enough capital is available, particularly right now when the world has enough capital to come into India's financial sector, which is a very attractive sector. Typically, this is a sector where earnings and in some ways values grow at 2x GDP. That generally is the benchmark most people use. So there's no shortage of capital coming in at 5%, 10%, 15% ownership. We can continue to have a very diversified ownership base. We can get foreign capital, we can get Indian capital. All of that with nobody owning more than a certain percent of the bank largely being run on a trustee basis by professional management, as it is the case all around the world. And as long as our banks are competitive, as long as our banks are run well, we will have plenty of capital coming in to support these banks. And so I think, if you look at it, both in terms of the problems we are trying to solve, second, in terms of, just sort of theory around how do people think about connected lending and what are the hazards of that, what are the problems of that. Many, very well-known academics have written about that already in the last week or so. So we know exactly what the issues can be in theory when you have connected lending. Or, and this is my final point, and I'll conclude with this, and Mr. Vishwanathan is here better to it than I can. Or if you look at it practically in terms of the regulatory capacity that RBI has right now, if you look at it practically as well, there again, if we are going to bring up these issues of connected lending, of adequate supervision, adequate oversight, I think it's difficult for RBI to step up and be able to handle all of that, because now they have to go in and look at corporate houses and everything that corporate houses are doing and where their money is flowing and how it's flowing in various different shell entities and all of that. So we massively expand the purview of the regulatory capacity, and as it is, RBI is short-handed. As it is, we've massively expanded the scope of RBI's activities by bringing in urban cooperative banks, by bringing in NBFCs. So we've already expanded RBI's remit massively, right? And then for them to take on this additional set of very complicated regulatory matters, I think would be very difficult to do at this stage. So when I look at across the options, what is the problem we're trying to solve, which is capital? Can we solve it differently? The answer is absolutely we can. Two, if you look at all the sort of theoretical issues or the academic analysis of what has happened with respect to corporate houses owning banks around the world, that doesn't seem like it's a positive. And third, if we look at it in a very practical way, in terms of what is RBI going to be able to achieve, are our regulators going to be able to step up and handle this new burden that is going to be placed on them? I think even there we will conclude that this would not be the prudent thing to do. This would not be the wise thing to do. So when I look at it across these three dimensions, what's the problem I'm trying to solve? What does the theory or the global benchmarking and the global experience tell us? And third, do we have the practical regulatory capacity to be able to handle this? On all three counts, I would have to say that as far as I'm concerned, I would proceed very, very carefully. It's fun to happen. We periodically had discussions on this matter, but at least as far as I'm personally concerned, as I said, I would very much be in the camp of staying with where we are right now. I don't think this will solve our problems. There are much better and more impactful ways of solving the challenges that we have in our financial system right now. Thank you.
Sir, a quick, because I've been very passionately working in this space. I would also like to hear your views about this recommendation of converting large NBFCs to banks.
And, Janzi, I'm also taking this opportunity to understand from you that, you are talking about three problems and lending is one of the biggest. Don't you think we also need to diversify our banking structures? Right now we only have scheduled banks, scheduled commercial banks, and we are not proceeding further on DFIs. We are not proceeding further on the other form of banking, from sovereign to the street vendor. We all are expecting only banks to cater to it. So it is time to strengthen NBFCs, MFIs, bring in the favorable regulations, and make lending easier for bank as well. It is very unfair for us to expect bankers to do the risk analysis of all sort of the consumer base. There are different type of risks, different type of capital requirement, different type of access to capital, which even these guys have. So it would be better, rather than going for changing the private sector's structure, we should at least start with diversifying the banks.
No, so let me answer both questions. First, Ramanji, your question about should we convert large NBFCs into banks because they become systemically important. Personally, I would be in favor of that for two reasons, obviously. One, because of better oversight through RBI and tighter supervision. Obviously, you have to build up regulatory capacity to deal with that. So I definitely agree that we should do that. And second, because as the large NBFCs become systemically important, by being able to take deposits, they can secure for themselves a more stable source of funding. And this will also give them the ability to get low cost money, stable sources of money, build up their brands, and increase our financing capacity and our intermediation capacity across the economy. So when our NBFCs reach a certain size, And whether it's mandatory or whether it's optional, we should think about it and obviously discuss it with the NBFCs. But I think that would be a good idea. Now, here, that when you speak to a lot of the large NBFCs, they are reluctant to become banks. And the reason is not because they don't want the low-cost financing associated with deposit taking. It's because they don't want the oversight. They don't want the regulation and they don't want the capital requirements, which, by the way, is exactly why we want them to become banks, right? So therefore, you have to really look into it very carefully and ask yourselves, why is it that large NBFCs that are at some level systemically important and too big to fail, you can't have a Bajaj Finance failing at this stage, right? I mean, of course, ILFS was too big to fail, but it failed. And look at the impact that it had. It drove up the cost of borrowing and froze the markets, the bond markets, for a long period of time. So it was systemically important, 1 lakh crore book, and so on. So I think it's important when you cross a certain line that you then be subject to the supervision of very tight supervision of RBI. And we can tell us, what is the Lakshman Rekha you cross when you become a bank in terms of supervisors, in terms of scrutiny, in terms of audit and all of that. But I think those controls are important when you cross a certain size. You get the stability of the funding, but more importantly, in some ways, you get much tighter regulation, which is required. Because of the systemic issues. So I'm in favor of the large NBFCs being converted into banks, and at a minimum being supervised much more closely. So that's to your point, Ramanji. Now to Anileshji's question about the diversity of financing institutions and do we have enough lenders in the market? Anileshji, I believe we do. And again here, because of the work that RBI did about 5-6 years ago, by introducing small payments bank, by introducing small banks, by introducing payment banks, by being liberal about NBFCs. Today, we have very good ecosystem types of financial players, each of them performing different functions. And I think, again, the challenge here is one of regulation and making sure that everybody is following regulatory guidelines and is doing prudent lending and all of those aspects of it. But in terms of additional structures and additional sort of institutions, I think we have quite a good diversity of of different types of financial institutions. And we just have to make sure that they're adequately capitalized, that they're adequately supervised, and that consumers themselves in turn understand what different financial institutions are for and which are not. Now here, for example, we've seen with chit funds and so on, that it's very easy to dupe people in India, right? And even if you look at, for example, what happened in Franklin Templeton, which was also is a sad situation, they're effectively invested in fund thinking that, their money was secure and they could get higher yields like a bank, while at the same time, not running any risk. But it doesn't work that way. And so we had sophisticated investors in chase of yield, putting money into money market funds, and those money market funds were not invested the way they should have. So that is an example of where our consumers, our savers themselves are not very familiar with the different financial institutions, what some can do and some cannot do, what are the risks inherent in those, etc., etc. So we also need to do quite a bit of work on the side of our consumers and our citizens, so they understand the different financial institutions and can take advantage of those. I'll just again conclude here by saying that particularly when you get to the middle classes and small town India, in many ways, anything that comes from a government, public sector bank or any other government entity, have to return the money. So if it's a Kisan credit card, most Kisans are not thinking that they have to return the money. It's just A, they roll it over, but B, they think कि सरकार ने दे दिया, ये मेरा है, ये मेरा हक है, मुझे मिल रहा है, मैं इसका उपयोग करूँगा. So as a result of that, we don't have good borrowing habits in India. We don't have sophistication about which financial institutions do we go to for what. And that in some ways is a bigger problem than the range of financial institutions we have. So, we really have to do a lot more to educate our borrowers and our lenders, particularly when it comes to the retail side. But in terms of diversity of financial institutions, I think we have done a good job of making possible many different kinds of financial institutions, and there's a full ecosystem where different players are in different niches. And of course, when they get to a certain size, like the large NBFCs, then we have to regulate them appropriately.
Thank you. Thank you, Mr. Sinha. Thanks for your insightful remarks. We also have with us Dr. Sachin Chaturvedi, who is the co-author of this internal working group's report. So can we request him to, help us understand, the context as well as the content, where he wanted to take the Indian banking side. Sachinji?
Thanks, Akhilesh. I heard Jayant Sinhaji, and I think he has very rightly captured, Namaskar, sir. And I think he has very rightly captured the plurality and the vibrance that we need in the credit scenario in India, and how the financial institutions can work well. I'm a little surprised that the reactions that have come on the report, though there are some extremely, I would say, encouraging write-ups that have also appeared. So that way, I think a report could attract criticism on the expected lines, and the appreciation also from the quarters that are very intensely engaged in the whole debate. In my view, there are 5 features of the report that I would like to capture this morning as we are discussing in a closed door meeting or consultation. The first and foremost is that this idea of Indian private sector banking be given to big industrial houses, and the fact that this is happening for the first time is quite misleading in a way, and those of us who have seen the emergence and a sort of space that private sector banks have occupied hasn't happened overnight. It has been there right from 1993 when the first reforms in this area were introduced. 2001 gave little more space, and 2013, I would say, was the turning point for the role of the private sector. And some of the critics who are dropping bombshells are actually associated with that decision of 2013, and that's when the scope and the mandate for private sector banks emerged and get sort of support from the Reserve Bank of India. So 2013 guidelines are discussed at length in the report, particularly in chapter 5 of the report. The second point that I want to make is in terms of the historical evolution of the private banking itself, and I would strongly urge to see chapter 2 of the report, where we have discussed the historical evolution and the genesis of the role that private sector banking can play. The third point that I want to make is in terms of the rationale and purpose, and some of our friends have questioned the timing, and I think given the collapses of the recent times that we have witnessed, both for leveraging the strength of technology and also our idea of 5 trillion economy, we require more of financial institutions in this area, as Jayanji very rightly articulated. We need expansion and we need scaling up. There are exit clause, as you would see in chapter 5 of the report, also discussed at length. So the firms that are not willing to play the role and want to go back, or NBFCs like Bajaj, if they want to scale up their business, the scope has been provided for that. Similarly, like it happened in case of ILFS, 230 companies who is interacting with whom we never knew that. So what we have done is to say that 2013 guidelines provided a sort of NFHC structure, and that should be sort of legalized, and necessary amendments in the 1949 Banking Act should be sort of undertaken. And in fact, you would find in the report that we have suggested at length what kind of amendment is needed. And until that happens, the RBI should strengthen the supervisory function, and then only we should go for. So these two caveats are very much there. The fourth point that I want to make here is the sort of suggestion of the IWG on supervisory functioning of the system. And there we have suggested revisiting the idea of fit and proper. So how we redefine it, what kind of strength we can really have in terms of leveraging technology and other barometers that as of now are missing. And we had detailed discussions with several of the deputy governors that have served RBI in the past and some of the practitioners. So CEO of the Bandhan Bank and many others in the sector whom we met, they all were of the view that more of technology is required, some additional investments would have to be made, and that is very well captured in the report. The second element there is in terms of listing of the banks. And as Jayanji would recall, during his tenure itself, Finance Ministry had issued circulars for banks to get listed. Tamilian Bank and Nainital Mercantile Bank, they have yet to get listed. Otherwise, the efforts by the government have succeeded in terms of encouraging banks to go for that. More nudging is required, but that would bring in transparency, accountability, and also greater faith of depositors. The third point there again is in terms of bringing in the amendments for the 49 Act. So as part of safeguard, that's another measure that has been suggested. And last point is in terms of global practices. And the report is very clear in terms of our efforts in terms of wide basing of the power rather than its concentration. And there, the dilution, if you see on page 31 in chapter 5, you would see a table that captures the dilution format, and that we have done across the guidelines of 1993, 2001, 2013, 2016. So these guidelines are captured in a table where we have suggested how 40% is the maximum, and then what kind of dilution, and in the 15th year, 15% is what is suggested. So this very clearly shows the inclination of the report to capture the capital that industrial houses can bring in. And that was one of the options in our mind, because that's how Indian economy has grown in last 70 years. So that cannot be undone. They are the ones who have the capital to infuse in recapitalization of the private banks. But that does not mean that they would get all the power and the authority on a platter. So the committee was of the view that we leverage that strength of the Indian economy for further recapitalization of the private banks, but we do not loosen the regulatory architecture. And for that, as I mentioned, several of these issues are discussed. The last point that I want to mention here in the fifth point is the bandwidth that is being sort of captured in the report. And you would find that efforts have been made to see that if NBFCs want to go on a higher level, the small financing banks, those who want to become universal banks, and those who of the conglomerates that are there, I gave example of Bajaj Finance, how the distance would be maintained, what kind of arm's length we would bring in, what kind of insularity we would ensure. And for that, 2013 guideline of NFHC structure for the financial entities to maintain, that has been not only reiterated, but we have also said that it should be incorporated in the Act so that it remains on the sort of mainstream of our fulcrum when we think of new governance mechanism. So with these 5 points, I think the report has captured, but those who are interested in dropping these bombshells, they have all got together, and and are again trying to sort of mislead the debates. And I would very honestly urge those of you who are thinking of writing out pieces. We would be very happy to share more of the details. The full report is out for public debate and discussion. But in the process of last 7 months, we have collated a lot of details, not only about banking architecture within the country and its evolution, but also globally. So I have myself seen of almost 22 global actors, how their ownership patterns and the extent guidelines in those economies have evolved. So I think those details are very much available. Those of you who are interested with further follow-up discussions, I would personally be very glad to be in touch, and I'm grateful to Anilesh Ji for getting all of us together. Thanks, Anilesh Ji, for this platform. Thank you.
Anilesh Ji, this is Ashwini. Can I ask a question to Professor Chaturvedi?
Please. He's Ashwini Vaishnav, BJP's MP from Odisha, and prior to that, he was a bureaucrat. Then he went to US to study and become part of MNCs. Now he's part of BJP and a member of parliament in Rajya Sabha. Ashwini Ji, mic is yours.
Thank you, Anilesh. Professor Chaturvedi, sir, I studied your report, and in your report, you have very the details in which you have mentioned how different geographies have different restrictions on whether the finance and commerce part of the banking and commerce part of it should be together or not. One point you have mentioned in your report is that there are very few geographies which exclusively prohibit this kind of ownership structure. So it was more like taking an example of other geographies not having prohibited and using that to say that, okay, it is okay to have corporates and industrial houses own banks. So I thought, let me ask you whether the experience of Japan, which has been considered by you, which certainly would have been considered by you in this report, what were the thoughts and what were the discussions on the experience of Japan on this? Thank you.
Thanks, Ashwini Ji. I think I can be a little more candid here. The text, as in any committee report, is always not a best outcome that you would very much like to have. And here I should be frank in this group in terms of the approach that RBI and RBI functionaries always had. So we had our own sort of internal, very intense discussions in terms of how the corporate structure should be identified and in what way they can be given the role that we feel should be given. And very conservative approaches have been there, and I think both with support and guidance with our chairman of the committee, Dr. Mohanty, two of us were very much on one side in terms of how we see the private sector expanding and getting the 5 trillion economy idea a reality. So when we were discussing several country experiences, the US very often would get quoted. But Germany and Japan, they were two sort of major exceptions that were sort of highlighted. And if you see the controls that have come in these economies, the trouble is that there were several actors that grew after Second World War. So when we look at the banking architecture of any country, we should not divide that of the nature and the growth of that economy, and that I think would be very important. That was our point when we talked about Japan in particular. The idea of chaebols that we see in South Korea, that is also the sort of reality with mega economic structures coming up in Japan. And as a result, on the banking front, you do not see a major concentration happening because the multiplicity of actors were there. And as a result, the banking architecture could grow very fast. In US, it remained led and dominated by few actors. In Japan, that was not the case. As a result, you find that plurality that Jayanji was mentioning very much evident, and so is in several of the European countries where sort of efforts were made whether monopoly or oligopoly was in a way came out of industrial architecture, but so were the small and medium enterprises, which grew much faster as part of the ancillary or the third industry part growing up. And that was the crux of argument. In India's case, very few industrial houses have grown very fast and have accumulated huge wealth across the 70 years, despite of several sort of dimensions. So they were the ones who could provide the bandwidth that a banking architecture would require. And this is why in case of the discussions that we have in the annexure, where in the report we have captured, our idea was to bring it, but then the consensus emerged in terms of putting it in the annexure. So in Japan's case, you would see that the plurality that MSMEs bring in also reflect the banking architecture that Japan has ended up with.
Ashwini, did you have anything in specific when you asked him about the Japan thing?
Yeah, Anileshji. So
the Japanese market, so that's why I'm asking.
No, Professor Chaturvedi, thank you, sir. You explained it very nicely. And see, the point that I was worried about is much of the bubble which happened in Japan and which led to a lost decade kind of scenario. A lot of academic papers, a lot of studies are there which show that the connected lending or the ownership of the banks also being the ownership of the industrial houses was one of the major factors where the funds got channelized into projects which were not really viable, but more like speculative. And that is what caused, I mean, not totally, but maybe a large, substantial part of the cause was this kind of lending. Now, we in India have a similar risk, and that risk would be accentuated in case ownership of banks is common with the ownership of industrial houses. So that's where the concern was. So I thought I'll just table this concern, and during the course of the discussions, we can have more ideas on it. Thanks.
Thank you. And just for clarification, Ashwini Vaishnavji is part of CIU. He's part of our board of governors as well. So from one board of governors, we are heading towards the second. Mr. N.S. Vishwanathan, former deputy governor, was recently joined CIU's board of governors. Mr. Vishwanathan, mic is yours. Your views on this IVG report and the whole structures thing.
Nilesh, just before Vishwanathan ji comes on, I just have a clarifying question for Sachin ji, just so for my own understanding. Sachin ji, I wasn't very clear when your remarks, which were very helpful in understanding this report better. Are you thinking of this ownership as a transitional thing, or are you seeing this as a design? And let me explain what I mean. So, for example, coming back to the earlier question that Ramanji had, which is, let's take Bajaj Finance. And if Bajaj Finance as a large NBFC has to become a bank, then we end up in a transitional issue similar to what Mr. Uday Kotak dealt with, which is he was a very large shareholder of a private bank. And then there was a transition issue, which is still going on in Kotak Bank, where his ownership relative to the prudential norms that the RBI has in terms of ownership of an individual in a bank has to come down to a certain level. And of course, with Mr. Kotak, that thing is ongoing, right? Similarly, if a large NBFC like Bajaj Finance, which I believe is owned probably 40-50% by the Bajaj Group, becomes a bank, we have a situation where we have a corporate house owning a large chunk of a bank, and then that, of course, has to come down over time. So there is a transition process by which if NBFCs become banks, then you have corporate houses owning a certain amount of equity in that bank and then coming down over time. And that becomes a transitional issue. And to expedite or enable the transition to happen, then you set up your recommendation. So that's a transitional aspect of it. There's another aspect which you also touched on, and that's the design part of it. There are broadly 3 flavors of capitalism, if you will, right? And I'll just characterize those as entrepreneurial Anglo-Saxon capitalism, which is what we see in the Anglo-Saxon countries, including the US. We have the more sort of zaibatsu, chaebol type of capitalism where, whether it's Korea or Japan, or to an extent even Germany, you have very large business houses, 6, 8, 10 of them, that have both banks, that have large, sort of number of businesses under them, and they effectively control the economy, right? And so that's the zaibatsu, chaebol style of East Asian capitalism. Capitalism. And that's what we see in China right now, where it's the public sector that owns 40, 60, 80% of the economy, and it's really state directed. But yes, they are acting as independent economic agents. So there are 3 different flavors, right, of capitalism. Now in India, we have a mix of all 3. We have entrepreneurial capitalism, we have, some large business groups and houses, we have state capitalism. All of that is mixed up. Now, when you are saying that corporate houses should own banks as well, are you saying that from a design point of view, you want India heading towards the zaibatsu chaebol model? Is that where you would like to direct the Indian economy? Is that part of the design, or is it to just enable it to some extent, and you want, this mix of different flavors of capitalism to continue? How are you thinking about it? Either were you thinking about it from a transitional point of view, or as a design thing to nudge the economy in a certain direction? That's the question I'd like to ask.
Thanks, Jayanji. I think excellent, very insightful question. I would say that as the introduction to the report very clearly brings out, the statistics that is there in terms of declining share, both in credit and in the savings that public sector banks are ending up with, they are yielding ground to the private sector banks. And you see that happening right from 2002 onwards till 2020 statistics that RBI could place before the committee. And we have got a flavor of that, but in the annexures, more details are given. So you see that it is happening both in terms of physical infrastructure, deposits, and also credit. That is happening. So probably we are ourselves going in a direction where private sector banks require a greater sort of response to the demand that is coming out from people. Now, whether we are really targeting on specific model, our effort was largely to see that in the last couple of years, the growth of the financial intermediaries that has happened, the growth that we see of NBFC, we haven't got into great details within this report, but we have suggested to RBI in terms of how those transition rules and regulations would be evolved by RBI. So our idea was to arrive on a sort of structure where you still continue to have stronger public sector banks, but also equally strong private sector space, which is adequately regulated and sort of provided support by the system. So probably we would end up with a unique sort of model where both the actors would survive very well. If I just give you an example of UCO Bank, and you see that continuous efforts are on, and even if I don't name any other bank, you would see that a continuous recapitalization, as you yourself at some point have dealt with this issue, you would see that the taxpayers, the money to public sector banks to salvage and continue would go only to some extent in some cases, but not in all cases and all the time. And as a result, they would probably end up in space where some sort of governance mechanisms, if they provide level playing field for them, they would go. So our effort was to bring in a sort of coherence across the guidelines. So in the broad model perspective that you are envisaging, at this point, I think exact response to that is not possible, because that was not our idea. The governance was certainly in our mind, but definitely if we see the net outcome of the process, probably we would be ending up with a mix of the three sort of very clear models that you have captured.
Can I ask a follow-up question on the same?
Yeah. But just be brief so that we can move the conversation further.
So on this slide, as we are discussing banking, so if India has to grow, say, for a GDP of aiming to grow at 8% in excess, then the credit growth has to be at least 20%. Without 20% credit growth, achieving GDP growth of 8%, years we have seen that the overall banking space is shrinking. Some of the public sector banks have emerged for the right or wrong reasons, and some of the private sector banks have gone out of the market. Overall financial market may not have been shrunk, but overall space is shrinking. There are only few players who are lending, and whether we can sustain a 20% growth with the existing state of finances which are available is questionable. So this is point number one, that how do we address the question of increasing the breadth of the market by bringing in the new players who can be possibly brought in by this report or by this discussion. Second point is that while we are talking about corporates coming in and playing a part in the banking, if we go back to the history, why we have migrated from corporates owning bank to a national bank or a different kind of structure, is that when the corporates were owning the bank, officially 15% of the lending was going into the same group structure, either directly or indirectly. Unofficially, that time in the if we go back to history, 1967, 1970, those time people would say that 30% of the overall lending was going into the same group, either directly or through the indirectly or through layered structure in those times. So if that fear still remain persist, that if we go into the private sector, allow corporates to go back into allow banking from the corporate sector, then whether we would again get into that kind of situation, which is certainly not healthy. So how do we marry both these situations? One side we need the breadth to increase, other side that risk persists. So how do we marry both these situations?
Kishorji, I think if you look at the broad sort of effort that the committee has made, is largely in terms of balancing this risk precisely in terms of better regulatory architecture, and also giving them the space that is required in terms of going back. Like for instance, Bandhan Bank, they are not really very keen in terms of going up further. And during the committee's deliberations with them, they were very keen that a part of their entity should go back to the role that as NBFC they are playing in the eastern region. So they want two separate initiatives that are required. Kotak Mahindra was also very keen that they create some of the NBFCs that are needed, and they wanted a broader sort of structure. We had also opportunity of interacting with some of the bigger NBFCs, and they are also very keen that they jump in the small finance bank structure, and then eventually in the sort of universal banks. So this transition that has to happen over the years for various entities, and then also providing them the exit clause if they are not very keen to go on. But in the process, what is required is to see how depositors' interests are protected and are ensured. And from that point of view, this group tried to bring in suggestions that can safeguard the interests of the several entities, provide enough incentives for them to take the risk. Because after all, if Kotak Mahindra is putting in, they are also at stake in terms of the amount that they are putting in. So to incentivize them, to attract them towards this role that the sector can play, and also in the process safeguard the interests of the depositors. So how do you balance the two and the risk for all the actors who are in the process, including the depositors? So that's what we have tried to do in terms of incentivizing, but at the same time not compromising the regulatory and supervisory functioning, and in the process also protecting the interests of the depositors. So risks were, I would say risks would have to be viewed at multiple levels and for multiple actors. And that's where the plurality, the first point that Jayanji made, I think assumes much greater importance, because that's where we need to safeguard. And that's what I think we have tried to do.
Thank you, Sachinji. Thank you. Now let's move forward. Mr. Vishwanathan, you are waiting. Mic is now yours. You can unmute yourself.
Thanks, Joseph, for having me here. Happy to be part of this very illustrious panel. And I think nobody could have put it better than how Chain Synergy had put up in terms of what is the problem trying to be solved and are these the solutions to solve those problems. So I think if you ask me, 3-4 things I think kind of emerged to me. One is that why are the public sector banks not growing? Is it that they are suffering from lack of capital? Then is there a way to do that? Is there a way to capitalize them better without having to involve too much of public exchequer money? That's one way to look at it. So if you look at, there was this Nayak committee recommendation which talked in terms of a bank holding company where all the shareholding of the government are held at the bank holding company, and the bank holding company is in turn able to leverage itself, and then through the bank holding company is able to control the public sector banks, and also kind of provides a professional rubber between the actual public government and the public sector banks to make it a professionally run organization. So I think one is that how do we improve the governance of public sector banks? How do we provide the public sector banks having to exchequer hard? That's good. The second point is, I think Synergy asked this very interesting question as to in terms of what are we looking at the larger business. So even the committee has said one thing, that they can have any amount of capital in the first 5 years, but after 5 years it comes down to 40. Okay, which means 5 years down the line, the new banks which are set up by the corporate houses will have to find 60% capital from outside. So if that, and as again Chain Synergy pointed out, there are banks which have that valuation. So if it's a question of growing, those people who will provide capital, 60% of capital for the new banks or the business houses in 5 years, ramp up the capital requirement of the existing banks too. Third is that we have created a range of financial service providers because India is a different financial entities risk appetites. So you have an you have an MFI, you have an NBFC, you have a small finance bank, you have a full commercial bank. And I think we have created that kind of a structure. Then an interesting data that I found in the report, chapter 2, is the bank to GDP ratio. If you look at India, it may not be as high as more than 100 in China, etc., but it's much higher than in the US. It's 98%. But we have a problem of credit being low. So we have to look at why is that happening? What is it that is making banks not lend? Earlier, there was this very, very restrictive licensing policy. Banks can go to any place. So I don't think in terms of structure, the current licensing regime in terms of who are the eligible players is that's the second point is the committee has Mr. Raman Agarwal also raised this issue about the question of NBFCs becoming banks. But if you look at the on-tap licensing regime for universal banks, NBFCs are not the eligible candidates for becoming banks. But an NBFC promoted a business house eligible because the business house is not eligible. So I'm not too very clear whether you should make a distinction between a bank promoted by a business house and a bank converted through an NBFC business house becoming a bank. I don't think in terms of the major issues that we are talking of, other panelists have raised, that changes whether irrespective of the route. Therefore, the problem whether industrial business houses have to be allowed to be licensed, that has to be settled first. Without that, I think licensing the larger NBFCs won't be business houses will not be correct, because again, as I said, all the problems in terms of the regulatory requirements, the legal requirements will apply to banks that get happen by of existing NBFCs to businesses. Last point I want to mention is that in terms of what the committee has achieved. So I have a little, obviously, the committee has also been very transparent on that most of the people whom it considered on the issue of regard to ownership, most of them were not in favor of it. But I think other than that, I think some of the things that the committee has done is to straighten a lot of kinks in our regulation. I think the banking licensing regime has a lot of kinks because banks have been licensed under licensing regime, and those regimes are continuing parallel. In terms of bringing uniformity, returning the kinks, all those things this committee has done. So I would rather, therefore, that let's look at the need for business houses entering banking business much more closely, because as you said, as some of the panelists have said, there is enough bandwidth even within the current regime or the framework that we have in place for banks to grow, and that is what we must try, rather than allowing a new set of entrants where there is lack of clarity on whether that's the right thing to do. So having said that, I must also point out that if the Reserve Bank included this as an issue to be deliberated by the committee, whether business should be allowed or not, meant that there was debate within the Reserve Bank. Otherwise, they would have asked for it. Obviously, there isn't a global standard on this. So the idea was to look at what is best suited for India. I think I'll agree with Jayant Sinha ji on this, and maybe some of the other panelists as well have been kind of talking on those lines. We haven't reached the stage where we believe this is the only way to go. There are other ways to spread our banking system within the current framework. I think that is what I would say. Thank you.
Thank you very much, Mr. Viswanathan. Now let's bring in Jeet Pai. Niti Aayog came up with the report that 3 of the PSBs that needs to be hived off and they need to be either privatized. We also have with us Charan Singh ji, who is chairman of one of those banks. Ajit, can you unmute yourself?
Certainly. Thank you, Andesh ji.
First of all, what Niti Aayog is thinking on both of these aspects. One, the IVG report, and secondly, how to deal with the PSBs rather.
So just a quick clarification on Andesh ji. Thanks for having me on board. But first, that there is no report where Niti Aayog has said that we need to privatize 3 of these banks. So that information is inaccurate. There's been no such report. So just want to clarify that.
I only
the second
media reports. I haven't gone through any other paper.
No, I think we can excuse Anilesh ji being a media man for that.
I'm so sorry.
Yeah, so there is no such report, and I'm in a position that I would know because I do look after banking, insurance, and financial services at Niti Aayog. So if that report was published by any part of Niti Aayog, I would definitely have had something to do with it. The second thing that I would like to also say is that a lot of my views are personal, because if the views have not been officially presented by Niti Aayog as yet, then they should be regarded as my personal views until such a report is out and Niti Aayog is publicly sort of spoken on the subject after having all the internal approvals. But there are 2 things that I want to highlight about the report. And the first thing is that the report itself is touching on some of the most relevant subjects of the past 10 years that we should be looking at. But when I run the math and I look at the sort of tipping points that had to be reached, as Jayantji has rightfully pointed out, with the public sector as a percentage of the overall banking sector falling to one of the lowest that it has in recent history, in fact, since the sort of 80s. The relevance of the public sector is becoming less and less. The numbers that they're provided of overall balance sheet and overall advances actually are camouflaging what the numbers are when you look at incremental credit over the past year or couple of years. So the very good news we have so far is that while all of these subjects that the report is dealing with are very relevant over the past 10 years, especially since at least a lot of the work that we have done shows us that the majority of the deceleration in the economy and economic growth has happened because of the financial sector. So almost when you look at 2010-11, you had about 24 to 25% year-over-year growth in banking credit advances, and it decelerated all the way down to low to mid single digits. So from a historical perspective, past 10 years, you can see that it's a massive headwind. Numerically, the banking sector is about 50% of overall GDP in India. And so if you look at the 25 falling to 5, you're looking at, a 2,000 basis points sort of headwind. And if it's, 50% numerically, you're looking at 1,000 basis points, a 10% headwind against, GDP growth. So the relevance of the question over the past decade has been very high. But second, given the fact that the public sector has not been growing in this period at the same pace as the private sector and the rest of the scheduled commercial banks, the question is becoming less relevant because those private banks, the HDFCs of the world, the Kotaks of the world, and all the others, have been able to grow to such a point at which the incremental credit from those banks is now actually greater than the incremental credit from the public sector. So yes, it is an issue. Was a very relevant issue. It is still a relevant issue. But I tend to echo the same thoughts that I think Jayantji had about whether it is the binding constraint, getting the corporate houses in right now is the most relevant thing or not. And I tend to agree with him that I don't think it is the most relevant part of the overall system. Now, what is the most relevant part of this overall financial architecture, which has been referred to by multiple speakers today? I think that the biggest sort of gaps, and why it's also relevant to this report on their comments on the NBFCs, the biggest gaps in our financial architecture continue to be long-term capital. So there's an asset liability mismatch with the balance sheet of the banks, where even the earlier mess that happened and required all the new regulations and tightening up of the NPAs and this asset quality review, etc., was to do with lending to the steel industry, lending to the power industry. So it is this big project finance that we talked about, but more than project. It's not just 5-year. It is long-term, large-scale lending, which was blocking the capital of the banks, which should have actually been focused much more on the working capital and sort of term loan kind of lending. And this is because a lot of the DFIs have become into banks, but also because our bond markets hadn't sufficiently developed. So when we look at I think other speakers have mentioned about the banking to overall credit ratio, India is similar to the US. Yes, that may be accurate. But the US also has a massive bond market relative to where we are right now. It has other ways of meeting those needs out there. And in India itself, while we've done a decent job with the growth rate of the bond markets, the size of the bond markets today are still not that relevant. Neither is the overall size of the NBFCs. They're still not, that relevant. I agree that the risk of one or two of these are getting large enough. So I would not debate what the report has produced. But what is missing also in India, other than the bond market functioning, is what I would call risk capital on the lending side, on the credit side. And the NBFCs were sort of serving that role of providing this risk capital. But the gap between demand and supply, and this we are giving you this gap before COVID. We're not talking about in a post-COVID environment because demand has fallen and eligibility has fallen because of COVID. But when we go back over the past 5 to 7 years, this gap between demand and supply for people that should be eligible for credit or are creditworthy had been expanding very quickly. The amount of demand had been growing much faster than the amount of supply because the banks weren't lending, because there weren't sufficient NBFCs of scale or with capacity at that point. And our rough math sort of came up with numbers between 500 million and about between 500 billion and $1 trillion in terms of unmet credit. Not that all of it could be captured. And that is sort of, when you look at an HDFC valuation, you look at these Kotak Mahindra valuation, what those valuations that were 10 times the public sector banks was reflecting that supply demand gap and the fact that the inefficiencies of the Indian financial architecture that couldn't meet that gap. So these banks could go at their own pace until a certain point where they could be cherry picking the right kind of customer. And so they'll have very low NPAs because of one is the capacity that they had, and second, that gap had been growing between both supply and demand. And people that could have grown much faster if they had access to credit and were creditworthy were not getting it. So I think those were sort of the factors that we are facing earlier. And I think one other thing, when you look at this report about the NBFC shifting over here as they become bigger, well, that might be okay. Looking at the overall NBFC industry and starting to regulate them like banks, giving them the same ratio as banks, all of that, I think takes away that market for risk capital. That risk capital of people that are willing to risk more. They shouldn't get to a scale, obviously, of the Bajaj Financials. I'm not suggesting by any means that Bajaj Finance be allowed the same risk, but up to a certain threshold, the NBFCs have to be given more room. Maybe better reporting, like I think the report to the RBI, maybe you can make it more periodic, the kind of reporting that you get from them. But that whole pool of capital, because if you don't get access to bank capital at that 6, 7, 8% that a lot of people are trying to get it at, for a home loan or securitized lending or unsecuritized lending from a bank, it's slightly higher. The alternative is like 18, 24%. That it is a very high rate of interest. The last point I wanted to make is that one of the reasons why I think also this report might be relevant is the relative scale. So we have come at Niti Aayog, we have gotten approached by some of the large corporate houses. When you look at someone like a Tata Group, you're looking at them and they're saying that, listen, there's no bank in India that can meet our needs. This is, you're talking about a couple of years ago, because the relative scale of the banks to the corporate houses hadn't been sort of matched in a way where the rules that said that you can't give more than 40% of your capital, that kind of exposure of your net capital to a single industrial house, was creating constraints for every bank, with the exception of maybe SBI, which means you're the only game in town. So I would say that, there was a need for our banks to grow much larger, at least a few large banks. There wasn't enough room on top. The public sector, while they were all different banks, operated like a single entity in terms of, the DFS being on board, the RBI being on board, and the NBFCs, which had a very short runway before they started running into trouble from a financing side because of that same asset liability mismatch. So we have to do some work, in terms of trying to figure out how to make the bond markets, if you're asking me order of priority, well, everything the report had touched on are relevant subjects from a historical perspective and will remain relevant going forward. The binding constraints are more in trying to make the bond markets more efficient and trying to create better risk capital. So I think I'll stop at that, Anileshji. And, those are sort of, I would call them my personal opinions rather than the Niti opinion. Thank you.
Thank you, Ajit. But I have WhatsApp you, that news clipping, which talked about that Niti Aayog is recommending that 3 of these PSBs, they need to be privatized. But if you are saying that it is not there, I'm taking it 100%. Thank you. Now, may I request, Charan Singh ji. Charan Singh ji is chairman of Punjab and Sindh Bank. And in this news report, Punjab and Sindh Bank's name also featured. And we had a brief chat about, privatization of PSBs with him earlier. Charan Singh ji, mic is yours.
Thank you very much.
As per Ajit, you are safe.
I'm safe either way. My own view on privatization is in public domain. The papers that I had written while I was at IIM Bangalore, much before I became the chairman of Punjab Sindh Bank. I still hold on to those views. First of all, let me thank Anileshji for having me over. It's been really a very interesting interaction since morning, and a very intellectual one. I don't think there could have been a better interaction than what we have had today. We have had the minister with us. We have had the board of the RBI. We have had the deputy governor of the RBI speak to us. So it's a dream come true to participate in such intellectual discourses. My own views, again, very personal, are as follows. I generally am used to thinking out of the box, and I think in a different way. And I apologize if some of you find it very awkward. But my question is, and I've been writing on this for some time now, there's a need for a bigger picture in the country. What has happened since 2014, a sea change in ideology, and a sea change in approach has taken place. I would like to have a single high-level committee on banking in the country. Why? Because 1991 is about 30 years ago now. Much has happened since then in India and the rest of the world. 2008 brought in a paradigm shift as to what regulation should be. From the soft touch regulation to really intense regulation is something that's very important. It just happened to be that in 2008, I was in the RBI and used to go to the IMF as part of my assignments and jobs. And you'll be surprised, even in 2009, when I finally joined them, I realized that the Fed Reserve and the American system was so keen to know how the Reserve Bank of India manages the regulatory and supervisory role in such a diverse country, and diverse country not only in terms of the country's geographical limits, in terms of the banking practices and banking institutions. I would also like to share with you, in 2004, when I was at Stanford, Janet Yellen called me 3 times to her office. She was the president of San Francisco. She was visiting India. Mr. Vishwanathan would remember that in 2005. She was visiting India and she wanted to prepare herself and understand how does the Reserve Bank handle this mammoth task. Given this scenario, now let me come to the points that I want to make. The first point, that we need a bigger committee to look at the complete gamut of banking institution, banking, including non-banking financial companies in the country, their position, their role. The thought I have in my mind is, if we have to have a $5 trillion economy, sooner a $10 trillion, and we are aiming to be a superpower in 30 years, we need to have a roadmap for us. I don't see that roadmap. So what happens? Somebody comes out with this report, somebody comes out with another report. The big picture is still not with us, and we keep reacting to these reports, which are hard worked and diligently brought out, but the bigger picture is again missing us. So there is a need for bigger picture. Now the question that I have is, mentioning about the public sector banks, again a piece that I wrote at IIM Bangalore before becoming the chairman, working paper. Let's think through this. The public sector banks got into the NPA mess probably much more because the DFIs vanished. And the point which had been made earlier, the public sector banks are expected to assess the commercial viability of a Mudra loan to the biggest road project that is being executed in the country. So what do the public sector banks do? Leave it to the State Bank of India or Punjab National Bank or Bank of Baroda, who are generally the lead in the consortiums, and just follow the leader after that without making their own assessment. If you look at the cases of NPAs and frauds and look at those ones which are sole and the consortium, you will be surprised 90% of the loans which are going bad are coming from the consortium loans, as if consortium ensures them from due diligence. That is the sad part. But the fact is that a commercial banker can only assess a commercial viability of a certain product. But expecting each commercial bank to have the skills to assess the wide spectrum of areas in which loans have to be given, it becomes a challenge. So the second point I'm making is the public sector banks assessment has to keep that in mind, the type of tasks that we have assigned to them. And maybe if we differentiate the infrastructure financing and bring back the DFIs, you'll find that the public sector banks are not that bad off. The third point I want to make is about nationalization, the very characteristic of public sector bank. I'm not sure if you have had the opportunity to think in deep about this whole story of nationalization that happened in 1969. Was it really done with the altruistic motive of reaching the remotest village in the country? If that be so, then why did in 2014, the Prime Minister comes and says, look, there is something going on funny here. And I authored a report in the Reserve Bank of India, sometimes in 2007, to look at financial inclusion. As you know, the term financial inclusion was devised by Dr. Y.V. Reddy. He was the governor. I was the GM at that time in the Reserve Bank, and I was the director in charge of banking research. According to us, the banking inclusion, the financial inclusion was only 30%. That report never saw the light of the day. Rather, Dr. C. Rangarajan was drafted in to come out with a better report, and despite his very best efforts to do whatever he could do, even he reached a conclusion that 50% of the country doesn't have a bank account. So financial inclusion was not there at all. So what was the rationale of nationalization? Was it really to reach the remotest corner of the country? Or was there any other motive? There's a beautiful essay written by Dr. Y.V. Reddy on the objectives of nationalization. And I can tell you for sure, it had nothing to do with the altruistic motive of reaching to the remotest corner of the country to either collect the deposits or to lend. It was totally political, totally political. Suppose nationalization had not taken place. Would this debate be taking place today in our country? In how many countries do we have public sector banks? If we say this all happened because of the Commonwealth, sure, but there were many countries in the Commonwealth. They have all given up on public sector banks characteristics. Similarly, countries like Russia, they have given up on public sector banks characteristics. So therefore, we need to think that we are still in the paradigm of a public sector bank. Should really that be true? And is it really necessary? If that nationalization had not taken place, was this paradigm that important? In this report, and I totally agree with the author, and the author is sitting with us, Professor Satish, I totally agree. I've been so hurt by the type of reactions that I've heard, and the most unfortunate part is that the former governor and the deputy governor want to write so scathingly against a report, which is basically a thought piece. So I totally support him. I support Professor Satish. It's a thinking thing. And in the thinking thing, at least there should be freedom. Of course, I am of the view that what is wrong in us that we doubt every industrialist? Why can't we believe for 1 second that industrialists can't be that bad? And we are so worried. The whole country is glued to the idea, oh, industrialist A or industrialist B will take over the whole banking sector. Are we so vulnerable and so weak? That surprises me. And also let me tell you that suppose for a second, industrialist A takes over one branch or one bank. We have 100 banks operating in the country. We have 12 public sector banks. We have nearly 50 private sector banks. We have foreign banks. We have cooperative banks. Incidentally, who owns the cooperative banks? There are 1 lakh of them. And the large NBFCs, who owns them? And just brushing all the NBFCs as bad, I'm sorry, I don't agree. There are some bad ones, as there have been bad banks in even America. So just doubting every industrialist and thinking the moment they get access to the banking, they are going to ruin the country. This surprises me the most. Why do we presume that firstly, the industrialist, every one of them is bad. Secondly, the consumer, me, will only go to the bank which this industrialist is running, and all other banks will have to put their shutters down. I find it very surprising. So I would rather say, given that so much has happened in the accounting, given the computerization, given the system of trailing the accounts, the modern accounting system is sufficient to help me make a distinction if I want an arm's length space and distance between me as an industrialist and the bank which the regulator is going to be regulating. I was in the Reserve Bank at that time. We started the primary dealer system, and then of course the satellite dealer system. The same issues came up. Can the commercial banks have a primary dealer? And we said, yes, they can. And we will ensure that the arm's length distance is maintained. And we ensured that. And primary dealer system did a great job in making market for the government securities. Because in 1991-92, if you remember, government securities market was at a very nascent stage. And today it's the most vibrant thing in the country. So therefore, I think too skeptical, and I stand with professors, certainly Satish, saying that this decision of theirs deserves a balanced view. And in my view, given that the financial situation, and the minister has been in the Ministry of Finance, knows the fiscal situation more than any one of us knows, I think this was, tapping the industry should not be considered so poorly and so badly. The last point I want to make is, just because of paucity of time, the regulatory capacity of the Reserve Bank and the supervisory capacity of the Reserve Bank is unparalleled, recognized by both the Fed Reserve and in my personal interaction with Janet Yellen. The type of spectrum that the Indian banking system has and the faith that the public has on the Reserve Bank is unimaginable. Starting from the small little institution, NBFCs, to the mammoth State Bank of India, this regulatory and supervisory institution has done a fabulous job. But if we have a high power committee on banking, which takes the whole view 360 degrees, can we think in terms of having a separate regulatory body of banks and financial institutions in the country, and the Reserve Bank is assigned the sole objective of ensuring monetary policy and the efficacy of the interest rate? Maybe a time has come. We need to think of a separate regulatory body. Thank you very much, Amleshji, and thanks for your patience. Thank you.
Thank you, Charan Singh. You are taking us back to the BN Sri Krishna committee report, and that era when people were talking about changing the regulatory framework of RBI, and there were also talks of bringing the insurance sector also as a part of larger regulatory framework, which our friend Raghuram Rajan peacefully resisted, and now I am very happy that Sachin ji in his report talked about harmonizing many of those rules and regulations with the law and legislatures which we already have, and bring them in tandem to each other, because we have seen that from that time, and in fact from earlier time as well, when privatization started, many of the regulations, they are running in parallel, if I'm not wrong, Sachin ji, to the stated law, and probably if some cues needs to be taken, this should be the top priority, to harmonize regulations with the law. With this thought,
Amleshji, I had a quick question for Sachin ji, just a clarification on the report.
Yeah.
May I ask?
Yeah, please.
So, Sachin ji, we have a category in India which is sort of corporate houses that are not necessarily promoter driven. For example, when you look at a company like L&T and you look at the promoter shares, they are zero. Also, if you look at certain banks, for example, Axis Bank is considered a private sector bank, even though the promoter group is all public sector companies, insurance companies that would be part of the promoter group. So when you were looking at, promoter driven, or when you were looking at industrial or corporate houses, were you looking at this distinction between sort of the ITCs and L&Ts of the world that are, zero promoters and just sort of supposedly professionally managed, companies without a promoter, with a promoter interest to zero? And also, how are you looking at situations like the Axis Bank situation, which has a promoter group, but it's, some of these sort of insurance entities? So how do we sort of understand how the committee and the report looked at these? Thank you.
No, definitely, this was very much in our mind. And in fact, if you see, at one point, we have mentioned our discussions with Bandhan Bank, where the CEO in his deliberations with us particularly brought out the point that they don't have a single promoter. And that would be true for those who would be going through that kind of transition when they are coming from, particularly from NBFC structure. And and even some of the others that are coming into the small finance bank category. So as I said earlier, the plurality of these categorizations that we have discussed in the report, they all have that bandwidth to absorb actors, multiple actors, and at times only single promoters. So this is very much discussed, and if you see the guidelines that we have suggested in 3 different places for universal bank, for small finance banks, and also for transition from small financial intermediaries, we have talked about not just promoter-led, but also groups to get into that kind of regulatory framework.
Thank you, Sachinji. May I now invite my personal friend, and he is part of Union Bank of India as a director there, Rajiv. Rajiv is an eminent chartered accountant. Rajiv, what is your thought? Please unmute yourself, Rajiv.
Thank you, Anilesh, and good afternoon to all of you. I think I'm speaking after hearing so much from such a luminary. So my task is now, very much little bit contribution I can expect at this stage, because already so many things I've said. One rider I would like to put at this stage that my views, whatever I'm speaking, is independent of my independent position in Union Bank of India, so should not be categorized there. And yes, see, when this report came in, and as I have been seeing for last maybe 1 year, more basically in the last 6 months something, there are group of people who attacks everything. I really congratulate and I agree with Charan Singh ji what you said, Sachin ji. You have touched the untouchable, and at the time when the economy is going down, and that's how the people are concerned. I mean, without even looking into the detail, the reality of a country, how it is happening. So we have a 2 set of people who are a naysayer. They will always oppose whatever new thing will come up. So without any, and they will give all sort of narratives which comes out with a very targeted set of commentator in a public, on a press, which will create an environment as if that all entrepreneurs are going to take away this country for a wrong reason. So that is the one part of that. The other part of that, there are other people who are trying to defend what is the existing situation because their status quo will be affected. So they are also there. Now, in between, I would put myself in between of the situation to make sure that both things should happen, and I'll give a logic and reason for that. One important thing which I have observed very interestingly, despite all hard work done by Government of India of late, of course, during 4-5 years and last 2 years, I can specifically say, see, all these private sectors banks which we are thinking about opening up, all good and is required. But the target segment, say, if you have a 63 million MSME, I'm surprised right now, only roughly 45 lakhs account holders are there, MSME, who are banking with the bank. So are these guys are going to help them? My answer would be no, because they are taking cream of them. So when we compare HDFC as say Union Bank of India or State Bank of India or Punjab National Bank, where is the comparison? Your 40% of the staff are involved in the government work for which they do not get any remuneration, and their operating cost is much, much higher. There they are hiring people from outside. So its bigger issue is not about the governance, its issue is about the governance, not about the structure of who is holding the shares. Now the point is that should we have those NBFCs, the large NBFC should be converted into the bank? What is the problem? Are they not still getting deposits from the public? If you have a mechanism of a proper disclosure, if you have a mechanism of a proper control, if you have a mechanism of a proper supervisory regulation, with all due respect to RBI, whatever they have done, in my understanding today, this regulatory mechanism and the way it is done is required to be changed. Let's admit this fact, because if we cannot find out a bank like one private bank, I'm not naming, that size could be a size of a branch in other bank, in a public sector bank, and to say today that all these things happen and nobody was aware, I'm sorry. This is not done. If I'm sitting here, 10,000 branches, if you can find out in every bank, there could be hardly 50 branches, 50 I can tell you, that will be basically representing all the bank. All other branches are there just for the name. They don't have the advances of that level. The third point, what we are saying, that why advances are not ticking up, sir. Your advances are not ticking up. I can tell you, there are huge amount of sanction which is not in the press. There are huge amount of sanction. The MCB is working full time. There is a huge amount of sanction, but there is no disbursement. I personally inquired why disbursements are not taking place, because there is no private investment. So malice lies somewhere else. We have to first uptick that environment, that why people are not doing it. We require some ticking in the income tax provisions which discourage, or the company tax provision which discourage the investment. Unless you allow those environment to happen, the people are not going to borrow and the bank will not go, reach that height. Also, I think there is some way we have left over what we thought when we merged these 4 or 5 public sector banks, and the 5 I can say at the top level. We wanted to create a top class banking and a large sector of banking to meet the demand of the country. These particular private sector bank, without doing a structural operational part, a structural helping, especially on recruitment, especially the way we train people in the public sector and the delivery and implementation part, their wealth will be transferred to this. There is no doubt about that. And these banks with those visions which you are thinking about is not going to be cheap. The next is what we are focused on the rural economy, and we are thinking about creating a agri-base and operation. Do you think that these private banks which are going to give, they're going to go there and going to provide services? I'm sorry, they're not going to go there. These are the public sector banks which you can go there. The address at this stage is to be done that while implementing this, you have to also see the problems which the public sector banks are facing. And if you can, help them in tiding those over those difficulties, I think they can match neck to neck in so many areas. If I have personally reviewed functioning of HDFC on governance side, on the top level and the bottom level, similarly for ICICI Bank, and compare with a lot of public sector banks. Look, these guys can hire people, fire people. Their operating cost is very low. They have a multiple, the channel through which they channelize and they get the business, which is not the free hand available to the public sector bank. Yes, some of them have now started doing kind of creating a separate structure where they will hire their marketing people. That is the problem. The other part is that, like what we are doing, I think the government of India has recently come out something called CASI, that is a cash over internet business, right? This is going to create a ripple in this MFI segment. Now, this is going to be a lending to 12,000 rupees lending to all DBT players. Now, these kind of structural requires a lot of investment, a lot of time, but the return is very low. If you ask all these private bank and other guys, they are not going to do these jobs. So when we evaluate their performance of public sector bank, we should keep into consideration that part. I have a full faith. What Charanji was saying, I'm fully in agreement with us that you cannot disregard all entrepreneurs in this country as the one which will going to do something wrong to the system. In fact, the transparency will force them. What we are talking about, that why should not happen, because there is something called connected lending. Let me tell you, the fact is today there is a more connected lending marked under the lap, because those people who are still connected with those top guys in the public sector bank and taking all advantages which are possible. Tomorrow, if they do it with their structure, they'll have to disclose those. I'll be more happy with the structure rather than this structure where I cannot even question it, because you are linked behind the curtain, not coming on the financial statement part. So I'm not in a position to know. So you have to have those appropriate disclosure. There is a lot desire on disclosure part. There is a lot desire on the control part. Like you see, I'll give you an example how in India people, throttle the government policies, especially Ajitji, because I had a discussion long on this issue, because I have done a survey, in fact, personally involved with a Setu program of Vishwa Hindu Parishad. That is a program which they collect people or they identify people for a Sishu loan. You'll be surprised today, Government of India's policy DFS, when it came out, that up to 50,000 rupees, there'll be no margin requirement, right? That was a prescription given by Government of India. I can challenge you, except for one or two banks, most of them are prescribing margin. Now you ask somebody going for 10,000 rupees, if you ask 5% margin, what the hell happening? So it happened, somebody identified me, I cross-checked with DFS that what was their requirement. So they have written, now this English also is a problem in this country. Somebody has written that in all other two categories of Mudra loan, the bank policy will prevail for margin. But for SISU, that may not be taken. Now, that may not be taken to be interpreted, not was taken out, must be taken. And therefore, everybody put in a margin requirement. The result is what is happening, sir, pressure-based lending, pressure-based lending. That somebody asked from DFS, I'm sorry, I'm telling you the truth. Unless we address the truth, you will not get the solution. So at the month end, if you want that these many numbers, people should come. So there are aggregator, you know, they are not listed or unlisted or corporate aggregator. They will bring those people and then give a loan. So, sir, Union Bank of India, this time I can take the name. We have come up with a solution, a straight through processing system we are bringing to address this malaise, where end-to-end digital we are going to do for this up to 50,000. So we have to identify the processes this way and then implement it. I personally believe there could be a hell amount of value creation in a public sector structure banks. But having said that, all banks are not going to survive. Second, create the environment, this your ecosystem, the judiciary, if some, with all due respect, if I'm talking, if they decide whether NPA account will have a provisioning or not, and what time it is going to have a provisioning, I'm sorry, then that is going to create an environment where people will misuse it, and they have already started misusing and provisioning. So that also is an aspect we have to tackle. This is literally holding us back from growing. Whatever growth numbers are you are seeing in the market, this is basically, I call it as a credit switch. Whereas 3-4 banks, including private sector, 1 or 2 public sector banks, they have taken the good, even in your retail, agriculture, or MSME, they have taken all those accounts from MSME, that NBFC, and it has gone towards the bank. Incremental lending is not happening. That is the trouble for this country. Right now, unless we create an environment for private sector investment or private investment, we call it a capex not happening, your growth parameters are not going to go up. So despite all those cleaning up on LSZ, you will see this December numbers may be troublesome. December numbers may be troublesome. Somehow, if you survive this December number and subject to Supreme Court ruling awaited by all banks, if that comes in, then you'll see something different. There'll be another period of 1 or 2 years of masking. I think that is not the way the banking should be done. So it is not who is the promoter. What is important is how we are going to allow people to perform in a given set of environment. What is the ecosystem? And a private sector with a set of a poor regulation and poor disclosure is something very serious. If you are going to give a license to a guy who can mask, there will be no people who are going to disclose. There are no people who are going to monitor. You see how SEBI, how SEC does it. If your expenses on say a simple of your employee expenses, if you have improved by 10% this year, they will send you a question, so moto. Please explain why it has happened. In India, we ask only those questions when there is something wrong happens, and then we start digging up that who has done wrong thing, what is at fault, and therefore the problem. So I would say 2-3 things on the structural part. Allow public sector banks for a recruitment policy should be more robust, so that, see, right now they're facing a big problem. They don't have a younger staff at lower level for operational. Everybody is at top level because recruitment has been stopped for a long time. Now, similarly, allow them to also charge some money for the services they provide to the government of India. If the government of India has to use them, they pay the money for those services. Let that be there, and then put them at task of non-performances. And the third part is that on governance part, strengthen the governance part of everybody. I mean, it's not only for public sector bank or private sector bank. I won't mind if some good NPFC tomorrow gets a banking license. If some good corporate houses gets a banking license, it's fine. It is there. They are creating competition. Had that not been case, sir, like I give an example. I open a corporate, the company few months back, and before I got a permission from ROC. Within 24 hours, 7 private sector banks sent me a letter that please open a current account with me. And none of them was a public sector bank. Why it is happening? Because they are providing services. The difference is in the quality of services, the implementation part, the delivery part. I think the top side, on the top level, we have done all good job. So if you want to create a top level bank, and we need it in the current environment, we need to have those structural reform side by side before we think about giving licenses. Because if we do so, all cream client, whatever right now existing, will also go there. And of course, there'll be a problem for a value shifting from the public sector, as it has happened in case of your telecom, as it happened somewhere else. So allow them to have those efficiency parameters and hopefully go with a mixed approach. I think that will be very, very tangible thing. So that's what my submission at this stage.
Thank you, Rajiv. Thank you very much for this elaborate, narration of your thought process. Now may I invite Mr. TTS Srinivasan. He is MD of Sundaram Finance and probably one of the few NBFCs who might want to become bank soon. TTS.
Yeah, so may I just jump in, Nilesh? So before TTS sir speaks, because being a veteran in the industry, and I think he's the one who, apart from having a vast knowledge, has actually experienced through the journey of the entire NBFC sector. So I think, sir, I know, I mean, your views are always something we always look forward to, but I have a quick specific thing, I think, which needs to be clarified as well as addressed, because this precursor to this report was a speech given by the Deputy Governor in one of the chamber events, where he set the ball rolling about NBFCs reaching a size and then being converted to banks. So I think there is some amount of confusion also. Okay, we say a 50,000 crore benchmark, NBFC reaches that level, then to my understanding, there are 3 scenarios possible. One, of course, I mean, if it reaches 50,000 crore, RBI says we will regulate you at par with banks. Fine. Now 3 options. 1, either you convert to a bank. 2, you continue to be an NBFC and be regulated at par with banks. 3, you scale down and reduce your size, and obviously then the regulation also becomes slightly lax. So is that the possible way, or is that the scenario? Please also include in your talk on this.
Thank you, Raman. Thank you, Anileshji. And thanks for having me on this panel. I'm conscious that, we're at the tail end, so I'll try to be as brief as I can. I think lots of very valuable opinions, some very frank opinions have been expressed, many of which I also share, and specifically on 2 or 3 issues where I'd like to weigh in are, I think as Mr. Sinha said right up front, I think we've got enough in terms of breadth in the system. What we lack is depth. And unfortunately, and pardon me for saying this, over the years, thanks to a combination of the media and also, I think, some unfortunate pronouncements that have come from people in positions of influence, NBFC has become a 4-letter word, which I think in many ways has prevented them from playing their meaningful and rightful role in credit delivery. Somebody made the point about, 50 years, I think Dr. Charan Singh made the point, 50 years after nationalization, if we're still talking about financial inclusion, clearly then something hasn't happened right. So that is one issue. So I think this negativity about NBFCs definitely needs to be done away with. And I think Mr. Pai made the same point. Banks are not the answer to everything. Banks have a very important, a very pivotal, a very central role to play, but I don't believe they address all the needs of this diverse and complex economy, especially at the inclusion end. That is number one. Equally, number two, I also think it is very unfair, the commentary that, all industrial houses, all corporate groups are out to play the system. I think that is being grossly unfair. I think there are any number of ethical business houses, promoters, on whose back really this economy has grown, especially in the last 30 years. So this constant refrain of misuse by industrial houses, by corporate houses, I think is extremely unfortunate. I think for any economy to grow, there has to be a healthy collaboration of government, of private sector, and the citizenry. So I think to single out one part, a very important part of the economy, and to sort of always have this burden on them of having to prove that they are clean, I think is grossly unfair. And I think that's one of the reasons that private investment has been very reluctant in this country. And number three, I think the point that several of the eminent speakers previously made, I think the death of developmental financial institutions, I think, has been a very, very big blow. And I would propose, without knowing all the diversity and the elements involved in this, if there can be an Asian Development Bank, couldn't we have an India Development Bank, which could be run absolutely professionally, funded in part by the government, but also then funded at a wider level, which can actually play the role which a DFI in a country like India needs to play. The reason ILFS happened was because they became a monopoly, right? But with the India Development Bank, with the proper governance structure, I think that is what will really address the long-term growth capital needs. And I think the right impetus with the right governance and regulatory structures for NBFCs, I think that is really what we need. And Raman, specifically to your question, I think I must say, and also in response to what Ashwini ji said, we are not an aspirant for a banking license. And I personally believe that the banking model is not the only way to deliver credit. I think we are very happy, and I think like me, there are several other peers amongst NBFCs who are very happy being NBFCs. All we would seek is better recognition of the role that we play, and probably a little more active developmental support from the regulator, right? We have no problem with being regulated, but we would also like to be supported in terms of funding, in terms of just raising our credibility with the public, rather than NBFC being this four-letter word. So I will stop here because, as I said, I'm mindful of time. But thank you once again for giving me this opportunity.
Yeah, I think one very important, sir, point which we have raised, and I think that is another point I would request, especially Sachinji and Mr. Sinha and others, sir, to consider. So while we have witnessed a scenario where time and again this issue comes up.
I'll stop you here. Actually, Ashwini ji has to leave, so let me invite him
sure.
So that we can hear him.
Yes,
Ashwini
yes.
Mahajan ji.
Sure.
There is some organizational meeting. So,
Ashwini ji, please.
Ashwini ji?
Yeah, thank you, Nilesh ji. In fact, I have nothing to add in this because so much of discussion has already taken place. In fact, I agree with the problems as has been explained by various speakers on this whole issue of banking. In fact, we have discussed at length about various issues, even beyond the point which we were supposed to discuss today, that is the industrial houses or the corporate houses getting licensed for the banking. In fact, this issue is very, very complex. And all would agree with me that that the complex issues always need some simple solutions. And if we try the solutions which are on the board, we have to be really cautious about the kind of the complexities we are into. In fact, I never hide my opinion about the Niti Aayog. They have always been a fundamentalist about the privatization of everything. May it be PSUs or it is banking or others. In fact, I don't want to comment on anything. But when it comes to the public sector banks, and I though agree with the Jan Sinha about the market valuation of the public sector banks, but I would like to ask everybody sitting in this room, virtual room, does this market valuation really tell you about the valuation of these banks? Perhaps not. In fact, the way share market works, the way share market gives valuations, you see, there's one simple example. Our government of India had come out with a notification, gadget notification, giving zero value to the shareholders of the Lakshmi Vilas Bank, and the share price was still quoted at ₹7.60. So how does this zero valuation in the government records and 760 in the market, how do you really reconcile the two? I fail to understand. So that means, and I have several other examples too, where the market valuation does not really reflect the true value of the bank. And we have to sit together. In fact, Charan Singh ji very rightly said that we have a robust system, and RBI had been when the whole world was in doldrum and the financial system was very much in bad shape throughout the world. The Indian banks were doing better than others, and everybody was envy of our regulatory mechanism. But the same Reserve Bank of India could not do anything when ILFS was happening, when we were facing we had been facing the huge problem of NPS. So these questions RBI should have answered, but we have a system where we can choose to keep quiet, or we just don't speak out anything. So, but when we have this solution, we have the problem of the lack of capital in the country. We do have the problem of various other kinds, but at the same time, कर लो दुनिया मिट्टी में, ये भी एक बड़ी problem है. I think I can convey this because we want to control the social media, we want to control the media, we want to control, I'm talking of a particular corporate house, and I want to control the e-commerce, I want to control the retail market, I want to control OTT framework, I want to control everything. And now if I am facilitated to control even the banking, so we have to, everybody who can who is somewhere in the policy making must think about these things, that this is certainly not going the way forward, and therefore yes, we need to solve the problems of banking at hand. But as Charan Singh ji had said, that public sector banks have played their role in so far as the democratization of banking is concerned. They have played their role in the in opening of new bank accounts. 35 crore new bank accounts have been opened by the public sector banks. Don't we give any valuation, social valuation to the public sector banks? Why do we always look at the market valuations? We need to answer this question. And recently, Niti Aayog had suggested the merger of three public sector insurance companies. I wrote to the Prime Minister, respected Prime Minister, please tell me, all your mega insurance schemes, which are the flagship schemes of the government, which are basically the welfare schemes of the government, they will be ruined if we somehow reduce the importance of these public sector insurance companies. And the Prime Minister took the cognizance of that, and that was stalled. You see, we have to really think deeper into what is the kind of society we are living in. The poor people, so far, some time back, they didn't have any bank account with them. Don't we need an inclusive financial structure, or we just have to think about the top 1 or 2, 3% people? So we need to answer this question. And yes, I'm not against doing some sort of experiment for in the banking, but whenever we do make such kind of experiment, we must have to stop and think what kind of society we are living in, what kind of needs of the people are there, and what are the kind of problems we have. The problem today is the capitalization of the banks. It is not because the banks have been doing badly. It is because of our political system, and it is a political failure. It is a failure of the RBI also, because that was also getting more and more politicized. So that failed to maintain the autonomous structure, and that is the reason why our public sector have done badly. So need to correct the problem where it is, rather than thinking of some other solutions. I'm sorry for being blunt. Thank you so much.
So I think I'm going to have to
Ashwani ji,
let me very quickly respond, because as a politician I have to respond to what Ashwani ji said, and I'll take just 30 seconds if I may. I think what we have to do is we have to be able to separate the social security aspects of what the public sector banks do and the commercial aspects of what they do. As long as we commingle the two, and we have an implicit subsidy that's working on the basis of depositors and minority shareholders with respect to the social security function, we're going to continue to handicap the public sector banks. So yes, absolutely right, Ashwani ji. We need better insurance. We need better financial inclusion. We need a much better system of providing support to our people. But I think that's best done through a social sector agency, which is set up absolutely to provide a safety net for our people and to provide them support that they need. Now, to get the public sector banks to do that actually makes it very difficult for them to then compete with private sector banks. And so we create an unlevel playing field, and we take our public sector banks and we trap them in this situation where they're neither a social security agency nor are they a commercial bank. So they're trapped in the middle. I think we've got to separate these two functions and make it very clear what is their role, what in the national interest should they do or should they not do. That is, I agree with you, that is a political decision. That is a decision that has to be taken. But as long as we continue to our sector banks in this way, they're going to underperform the private sector banks because they're going to go off and do what any good, smart entrepreneur would do, which is cherry pick the best loans and the best financing approaches that they can get. And that is the challenge.
Yeah, Ajit, you also wanted to ask.
I think Jayantji has actually echoed some of the thoughts that we had on the same subject, but there was a second matter, which is I think Ashwini-ji, if you can share with us where Niti Aayog has recommended to merge 3 insurance companies together, that would be useful for us, because while our opinion on privatization of banks and privatization of industry, I think you're right to say that Niti Aayog is very pro privatization of areas where the government shouldn't be participating, and that's been publicly communicated, including in this in the banking sector as well. This specific report of merging 3 insurance companies together is also something that while it was discussed by the cabinet, or at least if that's what the report, that's what the media reported, I don't think Niti Aayog has like you said, that the Niti Aayog has recommended that or provided that a report on that. I don't think that that's I would love to see that report. So if you could share it, I'd be grateful. Thank you.
We'll do that.
Now, Ashwini-ji, with your permission, let me invite Kishore-ji. He's from.
I'll take your leave. Thank you.
I'll brief you about the further communication.
Thank you so much.
Thank you, Ashwini-ji. Thank you.
Unfortunately, I also have to leave. Thank you all for a very interesting discussion.
Thank you, Jayantji. Thanks for taking your time out. Now, may I request Kishore-ji from Hinduja Group, Hinduja Leyland Group. Kishore-ji, can you unmute yourself?
I have already done it.
Yeah, please. And so just be brief, because we're actually running out of time now.
Done.
Yeah.
So do you have any specific question?
Yeah, you can tell us about your experience that,
Look, to some extent, I would agree with TTS sir that while we are into NBFC space has always been demonized. Whether it is the public, it is media, it is the courts. You go to any high court and then there is a case listed for NBFC, the judge would start with that you guys are the money sharks. So from where the discourse starts. So this is the general perception that has been built over the period of time. But we have to understand that NBFC exists for a reason. And because last mile connectivity was not available and it was efficient as well to do both in terms of reaching out as well as the collection part, which was not that effective. And it was not that effective till some time back. It is still not effective because, if you look at the microfinance companies, the way they operate, they disburse loans of 10,000 rupees, 12,000 rupees, and then still they are able to manage, collect all the EMIs, which are 200 rupees, 300 rupees, and still they are profitable. So in terms of their profit, forget about their profitability, look at the distribution network that has been created by a microfinance company, which is reaching out to the remotest village where there may not be an internet connection. They are going there, distributing the money, creating some kind of financial inclusion at there. So the very existence of NBFC is because of the ability to reach out to people and also to bring in efficiencies. I would say both are go hand in hand, where one hand the NBFCs and microfinance institutions are to reaching out to wider section of the society. On the second side, they are also bringing in efficiency. It is not that NBFC is just distributing money and unable to collect. If you look at the most efficient distribution system would be at this point of time would be microfinance. If you look at the NPA numbers across the horizon, which is the smallest ticket size setup. So where it will be very, very wrong to say that NBFCs are the bad apples in the cart. Otherwise, we would not have seen a GTL bank, we would not have seen a PMC. If bad apples are there, it is there in every sphere, not into only banking, not into NBFCs, and there are this mix was there, it is there, and it will continue to be there. The issue with NBFC sector is that it is from the regulator side, people keep on saying that it is least regulated. I would say that there is no handholding. If you go to a regulator, I would not I would not hesitate. These are my personal views, not the opinion of my organization or the organization they represent. As a industry or as a general citizen, I believe that regulators are doing the policing job, which is not the correct way. There may be mistakes, deliberate or otherwise, from the sectors, from the individual organization, individual structures. But if the regulator come with a solution and give them the adequate training or adequate handholding or migration time, then it would be a much healthier environment rather than putting some penalties here and there, putting some strictures, some media report that this has been done. So that has been the problem with the sector, specifically on NBFC. So I would rather say that all the NBFC exist because of a reason, and it should continue to exist. Regulator and all the other who are interested in financial inclusion, they should help NBFC grow and strengthen, rather than the looking the other way around, or they converting them into a bank. Or if the banks can do it, then why the NBFC would exist in the first place itself? If the banks can do everything, then why you would create an NBFC infrastructure at all? So this is where the disconnect is, and I think both can coexist, both banking as well as NBFC, both can grow. The problems are there, problem will continue to there. So we have to create a mechanism and create an environment where we should not look at bank versus NBFC or anybody else. It both can grow together. This is my view on the NBFC space as well. And second thing which I would like to highlight, which is I think very important, which is the increase in the promoter capital in banking sector. I think it is a very, very good and thoughtful decision. To some extent, my personal view was always that reducing promoters capital below a certain level is not healthy. Because if the promoter, the skin in the game has to be there. The more the skin in the game is there, the governance and skin in the game both should play an equal role while developing any financial system and banks. So if the promoter has a 26% stake in the entity, he would continue to remain interested in the stake rather than having a 10% stake. So it is a very, very good step suggested by the working group, and it will certainly help. If it happens, it will certainly help the banking sector to grow further, especially the private sector banks.
Thank you, Mr. Lodha. Now may I request Kapilesh Jain ji, he's CFO of PNB Housing Finance.
Please unmute. Please unmute.
Please unmute, Kapilesh ji.
Yeah, Animesh, I'm Kapish here. Yeah, thank you very much. I think a lot has been spoken. I really appreciate being part of this panel, and I got incited by what Mr. Sinha mentioned, and it's a pleasure to be here and heard Mr. Sachin as well. I'll keep my conversation very limited to the extent of how does it benefit NBFCs. We are a housing finance company, and we are somebody who's sitting at 80,000 crore of balance sheet. So we categorically qualify under that criteria where we can look for a conversion to a bank. But not talking about PNB Housing in particular, but just to highlight the element that it's a good move, because over the last 3 years and every few years, we see that because of some sectoral issues of some player going bad, whether it was ILFS or maybe DHFL that we see in the recent past, NBFC, the sector, like what Mr. TTS mentioned, becomes a four-letter word. It enables or it disables your ability to grow. Your liability suddenly becomes expensive. Your ability to get money from various sources becomes a challenge. And you're also viewed very, very suspiciously there. If you then suddenly become a bank, your governance level goes up. You get a support from the regulator, where the regulator is available to you as a lender of last resort. So your problem with regard to ALM, balance sheet management, liquidity, to some degree gets taken care of. Your governance moves up as well, because when the regulator like RBI comes and starts governing you, you are viewed differently and you are becoming far more disciplined. Another important element is that the level playing field which comes into play. If you simply look into the regulation which gets applicable for a housing finance company who so far have been regulated by the National Housing Bank, or the banks which or the other NBFC which have been regulated by the RBI, there are various elements of differentiation which is there currently, which is creating confusion as well. Any such element of making it all similar and level playing will also bring in a lot of clarity and bring in a lot of investors as well into the sector. So I would believe that this is a good move, and and NBFCs who can look into this particular opportunity should progress to take care of many of the systemic issues that they sometimes face from time to time. Thank you very much. I don't have anything more to say.
Thank you, Kapishji. Mr. Vishwanathan has raised his hand. I think he wanted to intervene. Mr. N.S. Vishwanathan?
Hello?
Yeah.
Yeah, I just want to say a couple of things. I think, again, in the context of what several speakers mentioned. One is that, see, the NBFC has been allowed to convert into a bank anytime. Even in the 2013 guideline, even in the SFB guideline, the on-tap guideline, all those NBFC becoming a bank is something, what do you call, the readily eligible entity to become a bank, even as per any regulation. What this report said was that if it is a larger NBFC, more than 50,000 crores, even if it is held by an industrial house, that should also be allowed. So I think that's the difference. I don't think the difference is in terms of NBFC being eligible. NBFC is eligible any which way. So I think I just want to answer the point which Mr. Kapish also raised. So this was available any which time.
That is correct. That is correct.
Okay,
yes.
Right. The second point I want to mention is that I think a lot of things have been talked in terms of, I think the point which, what do you call, Mr. Raman Agarwal is the first issue, which is regarding the recent mergers, which RBI has developed. So one important point I want to mention is that the difference between a foreign bank and a subsidiary of a foreign bank is that the subsidiary is treated as given a near national treatment by the regulation. That's one point I want to make in terms of a technical issue. Last, I think the point which Professor Charan Singh made with regard to the issue of financial inclusion. So I fully agree that the public sector banks, the nationalization did not help the cause of financial inclusion. The growth of banks in rural areas did not happen. RBI has to make specific regulations saying that unless you open X number of branches in a rural area, you could not open a branch in metro. All this is required, even public sector banks. Otherwise, they were also trying to open more branches in the metropolitan area. That is where I think the differentiated types of banks, so I think have come in, because I have said that the small finance bank came from the concept that so long as priority sector lending does not become the business of a bank, priority sector lending will not get the leg. So the small finance bank model was created on the principle that you make priority sector lending the business of a bank. That's what happened to small finance bank. They have 75% to be, PSL, 25 lakhs, ticket size to be 50% of the loans. So all these were directed in that trend. So I think in terms of the policy approach that has been taken by the government and the RBI, it's to create several types of institutions, because India is a vast country with a diverse set of people. And again, I think I agree, that if it was not required by the NBFCs, so NBFCs also play a role. So I don't think, it's not that everything can be done by the banks. You need different strands of financial service providers. And I think that is what is the ecosystem that we're working towards. We need to, we have public sector banks. We need to, they are an important part of the system as of now. I mean, we'll go forward whether they should be privatized. That's something we can look. But I can tell you there are international models of government-owned banks where they're working like private sector bank. There are ways of doing that. I think that is one of the suggestions which the Nayak committee had given. So there are ways to strengthen the public sector banks in terms of how they work, how they raise capital and function. I think Mr. Jain had raised the issue of what you call autonomy and things like that. Those are things that can always be done. So I don't think that the banking system in India is waiting for a large entrance to come to take the growth forward. That's the way I see it.
Thank you, Mr. Vishwanathan. Charan Singh ji, you wanted to speak? Unmute yourself, Charan Singh ji.
Please unmute, sir. Please unmute.
Charan Singh ji, unmute yourself. You're not audible.
Yeah, here I am. Now, Anlesh Ji, this is because it's a fabulous forum that you have organized today. I just want to make a brief point. I have a feeling the NBFC sector has neither been appropriately recognized nor their role properly defined. And if you look at the American model, and if we call the NBFC as shadow banks, look at the role that they have played in the Western world. My feeling is to make NBFCs themselves appreciate their potential, as well as make it a part of the supply chain of finance, starting from the apex Reserve Bank to the commercial banks to the last man on the street. The funnel has to be proper. The last leg of the funnel is NBFCs. They have not been properly appreciated or recognized, or the system has not been properly designed. A time has come, if we are looking at a seamless flow of resources, NBFCs need to be strengthened. How to go about doing it? The people in the board of the RBI, as well, I think in the ministry and Niti Aayog, they will have to put their heads together. We will need a committee which will say the role of the NBFCs, the road ahead. We need to have a roadmap. Thank you.
Thank you. Thank you, Charan Singh Ji. I think with this, we can actually conclude today's wonderful discussion. It was a really, really bright Sunday morning. And on this Sunday morning, we gathered to, discuss very, very pertinent topic. We all agreed that banking structure need to be altered with. And the banks require private capital. And how it should be brought in, the initial idea which the committee where Sachin Chaturvedi was part of, they have given us a starting point. We can build on this conversation. Certainly, there is a concern about the relationship between the creditor and lender. And Sachinji, we all would agree that there are technologies and regulations which can ring fence these two communities, and corporates can keep these two aspects at an arm's length. So I'm sure the future is about using the technology and regulation and utilize the capital which we have inside the country, or the positive capital which can come from outside the country. I'm grateful for the friends from NBFC world who have come and given us the perspective that how many of the NBFCs can still stay in the present structure, or if they want to re-christen themselves into banks. Sachin Chaturvedi's committee has made a very considerable argument that they can still be converted into a bank size with the present corporate structure, and maybe with the transition and with future things can be brought back to the the required structure. But Sachinji, I would be very keen to understand the how, like Jansena was asking you, that how would non-promoter led organizations they can get into it, because ITC is actually looking at setting up some NBFC like organization, and now farm sector is opening up, and agriculture finance would be a big ticket thing. And right now it is a monopoly of either the agents, or we call them artiyas in Punjabi, or procurement agents, as rough translation into English. Secondly, there is a presence of public sector banks, and still the organized sector of lending is less than 25%. And I'm sure this is a big area where many of these players would want to go. And probably you might have, I haven't gone through the report as yet fully. I'm at chapter 5 level as yet. So I'm sorry for not completely reading it, although it was my commitment to you that I will read it before joining this discussion. There is a requirement for industrial finance. There is a requirement for DFIs. there is a requirement for power sector finance as well. Jayant Sinha ji is not here, but we had a long chat with him about DFIs and power finance institutions, and especially when renewable is entering into a different phase, especially from the manufacturing side, and we would require finance for our manufacturing entities, and all these are different risk profiles altogether. And expecting the scheduled banks to answer many of these questions would be very, very unfair. So there is requirement of private capital, regulated capital, and capital where we can see more transparency. NBFC, Ramanji, I agree that it plays a very critical role, but we also have to agree that there is a lesser transparency in the NBFC sector. There are legacy issues to it. The data is big issue. We both have conversed many a time how to make this sector more transparent. Listing of NBFCs is an issue. So we maybe in our next decade is there, where we can see more of private capital flowing into our finance sector, especially the risk capital from the debt side. I'm thankful to all the speakers on behalf of Ramanji, on behalf of Avtar Monga, on behalf of NS Vishwanathan, who is a part of our board, plus Ashwini Vaishnav, who is also part of the board, Ashwini Mahajanji. I thank you all for joining us, giving your insights. Maybe last word, Sachinji, because you have made a great effort in putting these papers together. If you want to say something in next 2 to 3 minutes, mic is yours, then we all can disperse.
No, thank you. Thanks, Anileshji. I won't take much time. I think we are already late, and I think on a Sunday, it's rather long drawn. I think at the outset, must thank you for getting all of us together and getting this extremely stimulating discussion. First point, I think what Mr. Ajit Pai and TTS have said, I think is important in terms of the fact that report might be of some use in terms of scales that we are talking of. The fact that we are talking not just of bandwidth, but we are also talking about the depth. And I think both are absolutely right that we required that gravitas in the credits market. The fact that NBFCs have developed this network is important. Professor Charan Singh has, I think, very rightly observed that even after 70 years, and within RBI, I am chairman of the Eastern area. And in Eastern area, I am realizing that even after 70 years, villages with 5,000 population have not a single branch. And there are several such villages. You go to villages with 2,000 population and you go below 2,000, it is an amazing story. And there are several who do not have even the business correspondence. The BCs are also missing. Technology to provide support for credit, the optical fiber network which BharatNet is laying out. In all of my meetings in Eastern area, every quarter I am reviewing, and everywhere huge disappointment. And on the contrary, if you see the business of Bandhan Bank, you see the business of the NBFCs, it's amazing, it's impressive. In fact, the number of NBFCs in whole of India and in Eastern area, they are two separate. The quantums are not huge, but numbers are huge in that. So when private sector can excel, can economize and provide services, they should be given support. And I think no one here is saying that private sector should only be allowed and public sector should be wound up. But as Jayanji very rightly said, we need to delineate the social obligations vis-a-vis the commercial applications. In fact, there were several public sector banks whom I met in Itanagar last quarter meeting of the RBI, where they were telling me that they sanction vehicle loans, and immediately outside the branch, HDFC people come and take over the loan. So the scrutiny and the effort is done by the public sector, and advantage of that is taken away by private sector banks. So, Anilesh ji, the trouble is that gradually we are ending up in small projects and not projects where a huge capital is required. In fact, in chapter 2, you might have seen a table which we got inserted in terms of the bandwidth of the public sector banks and that of the private sector banks. So you do not have anything. And I think one other suggestion which from RIS we had mobilized 3 months back is to have development banks, and the debate at the global level is multiplying because the regional development banks are not playing the role that they could have in terms of financing mega development projects and on top of that to cover the risk. So public-private balance and the banking structure to provide risk coverage to our development projects is something that is extremely important. I won't take much time and would stop here. Thanks once again for very stimulating discussion. And I would strongly recommend to read chapter 5 of the report. The others are fine. They are more history and context setting. Chapter 5 is the crux of the report.
Thank you. Thank you. In fact, Sachinji, I would recommend, if you can connect with Ashwini Vaishnavji. He has a strong point of view on Abenomics. Especially on freeing up capital from for the sovereign lending. So he is of the view that central bank should directly lend to the sovereign rather than coming to banks. This will actually reduce the cost of capital as well. So reducing the cost of capital would mean that fiscal deficit would be much lesser, and sovereign can actually gain from the dividends which RBI would be gaining from charging the interest. So the cost of capital can actually come down. So this is his point.
The only trouble would be of the supervisory and governance part of it. Anyway, we can discuss that later.
Yeah. Japan must have developed, some of this aspect. So we can study that, and maybe with a smaller group, we can discuss that aspect as well.
Thank you.
Thank you. Thank you very much. Thanks everybody. Thanks Jalaji. Thank you, Ramanji.
Thank
you, Mr. Vishwanathan. Thanks, Ajit. Thank you, Shorji. Thanks, Rajiv. Thank you very much.